Hello, I'm Jason.
I'm Emma. In this video, we'll break down a key investment concept: investment risk.
What is investment risk? It is the chance that your investments can lose value. In other words, the risk that's taken for the potential reward of investment returns. Like most things in life, you have to risk it for the biscuit.
Let's talk about your risk profile. This accounts for the risk you are willing and able to take. Each investor is unique with different goals that dictate your willingness and ability. Like your social media profile, your risk profile is also customized to you.
Your risk profile will consist of both your risk tolerance, or in other words, your willingness to take risk, and risk capacity, or your ability to take risk. These are very different concepts.
Generally, the higher the risk, the higher the potential for reward. However, with higher risk, you're also accepting a higher potential for loss. Each investor needs to understand how willing they are to take this risk. For example, if you held $10,000 in equities and the value fell by $1,000, what would you think? A, no big deal. That's the price of investing in shares, and I'm more focused on the long term. Or B, $1,000? I could have gone on vacation with that money.
If your answer is A, that suggests you have a higher risk tolerance. If it's B, that suggests you have a lower risk tolerance. Neither answer is right or wrong, but understanding what you're comfortable with is important. While it's not ideal, sometimes investors realize their risk tolerance isn't as high as they thought it was after they've invested. If you find yourself constantly checking your account balances or worrying about your portfolio at night, that can be a sign that your risk tolerance is actually lower than you initially thought it was.
Now let's talk about risk capacity. This is the amount of risk you can afford to take. Your age, income level, and time horizon normally influence your risk capacity.
Let's dig into that idea a bit more. Say you're investing this money to save up for university, which is coming up in a few years. In this case, your risk capacity is low, as you need the money in the short term.
Each investor will also have multiple goals. Your short-term goal could be saving for university. Your medium-term goal could be saving for a house. And if you're really keen, your long-term goal might be to retire on a beach one day.
The longer the time horizon for your goal, the more risk you can likely afford to take. Deciding how much risk you can take will affect what investments you ultimately choose for your portfolio. Another consideration is thinking about how your risk tolerance and risk capacity align with each other. If you find that your risk capacity is greater than your risk tolerance, consider educating yourself regarding the benefits in some instances of risk-taking. Alternatively, if your risk capacity is less than your risk tolerance, you may need to consider repositioning your portfolio.
Let's look at some traditional asset classes here. Cash has low risk and low potential for returns. Fixed income has a low to medium risk and return potential, and equities have a higher return potential because they come with higher risk. While you're saving for your short-term goal, for example, the cost of university, you might want to lower your risk by investing in fixed income or keeping cash on hand. However, that beach chair in the sand might require some higher returns from equities.
Now that we know what risk is, we need to ask ourselves, how can we measure it? One of the most common ways to assess an investment's risk is by looking at a measure called standard deviation. Standard deviation measures how much the value of an investment can change. This is often referred to as the volatility of an investment.
For example, let's consider the standard deviation or risk of an investment. Let's say you began the year by investing $100 in a security with a standard deviation of 5%. This means by the end of the year, you'll likely end up with between $95 and $105. This is fairly low risk. If the same security had a standard deviation of 20%, you'd likely end up with between $80 and $120. This is high risk. It's possible you can end up with an amount outside of these ranges, within 2 or 3 standard deviations, but this would happen less often. This is because 68% of the time, the outcome falls within 1 standard deviation for the mean, or in the dark blue area of this chart.
Just to bring this home, let's think of standard deviation in another way that we all understand, the weather. We all do the same thing before we head out for the day. We check our trusty phones to see what kind of weather we're heading out into. Let's say the weather forecast looks pretty good, but there's a slight chance of rain. Now, we all know that slight chance can also turn into a real chance of thunderstorms. That's a risk we take going outside each day. And understanding that a probability exists for that event and that it differs day to day is a good way of thinking of the risk for investment returns.
Luckily, standard deviations for securities and investment funds in Canada are often calculated for you, saving you the time of calculating it yourself. For investment funds specifically, a risk rating is assigned to each fund, ranging from low risk to high risk, so you can select the investment fund whose risk rating aligns with your risk profile.
Hopefully, this video has been another helpful step for you in your education on investments.
Remember, understanding that all investments come with risk and assessing both your willingness and capacity to take risk is key to your investment journey.
Thanks for joining us today. Make sure to continue following along with our videos to learn more about investing.